Welcome to a pivotal moment in the financial world. The year 2026 has begun with a shocking turn of events. This is not just another rumor. This is a confirmation from the authorities themselves. At 11:47 p.m., December 31st, Shanghai port authorities rejected silver cargo destined for Cox-approved vaults. The financial world is on edge as the first sovereign default of 2026 has already taken place. This news is not something that can be ignored. The world is still adjusting to the new year, but the financial markets are already in turmoil. This is not a minor setback. This is the first real warning sign that something much bigger is happening. The markets were supposed to be asleep, but the clock began ticking long before anyone had a chance to react. This moment has been coming for a long time, and now it has finally arrived. At 11:47 p.m., Shanghai authorities sent shockwaves through the financial markets. The emergency phone call between New York and Beijing didn't go as planned. The United States had hoped for a quick resolution. They needed China to step in and save them from what was about to unfold, but instead, they were met with a rejection. China has said no to the bailout offer, a move that sends shockwaves through the entire financial structure. The world of finance is about to experience something unprecedented. The markets were not prepared for this. A few hours ago, I posted a video warning you of an impending crisis. The 48-hour window I gave you has now shrunk to a mere 8 hours. Sources in China confirm that the January 1st export restriction law is being enforced early. The dominoes have already begun to fall. This was not the timeline anyone expected. The cargo, once set to leave for Cox-approved vaults, now sits idle at the Shanghai ports. The financial system is on the edge, and there's nothing anyone can do to stop it. As the clock strikes midnight, the ports in Shanghai are dark. The cargo is sitting idle, and the COMEX market is on the brink of collapse. What was once a thriving market for silver is now experiencing a massive physical delivery problem that threatens to undo everything. A physical delivery problem that cannot be solved with paper. No amount of algorithmic trading can fix this. The silver is no longer available, and this will force the market to react in a way it never has before. In the past 12 hours, while many celebrated New Year's Eve, behind the scenes, a jet left JFK Airport, destined for Hong Kong. What's more important is what was aboard that plane. It wasn't just any routine flight. On board was a delegation from J.P. Morgan's commodity desk, along with representatives from the CFTC and the Chicago Fed. Why did the Chicago Fed get involved in a private commodities negotiation? This is about more than commodities. This is about ensuring the stability of the entire financial system. Why would the Chicago Fed be involved? Because they know that if COMEX defaults, the derivative exposure could cascade into the banking sector in just 72 hours. The implications of this collapse are far-reaching. And it's not just about silver anymore. The entire system could crumble. The delegation arrived in Hong Kong, and by the next morning, they were sitting at the Shanghai Futures Exchange. An emergency purchase agreement was on the table. 50 million ounces of silver, paid for with U.S. Treasuries and backed by a bilateral currency swap. The deal was designed to bypass the restrictions of January 1st, using a loophole in the Phase 1 trade agreement. A last-ditch effort to save the system. But Beijing said no. They didn't just reject the offer. They rejected the entire premise. There was no negotiation, no higher price. The offer was as generous as they could make it, but China refused. It was a harsh blow, and the financial world is still reeling from it. This wasn't about money. This was about something much bigger. This was about control. Beijing looked at the synthetic market in New York, and they saw a market built on promises, not physical assets. They had the actual metal, and they were not about to release it into a broken system that had been built on falsehoods. And this is where the mainstream media will mislead you. They'll call it a trade dispute or tariff retaliation, but the truth is much deeper, and the narrative is carefully crafted to hide the real reason why China rejected the deal. This isn't a simple trade dispute. This is a systemic breakdown. The mainstream financial media doesn't want to admit what's really happening. They want to keep you in the dark about the true reasons behind China's rejection. Now let's talk about the mechanics. The COMEX market is set to open with 12,000 active contracts, each for 5,000 ounces. That's 60 million ounces of silver, but the registered inventory was only 41 million ounces, a shortfall of 19 million ounces even before China's refusal. This is where the problem begins. The registered inventory is already inadequate, but now, the expected silver deliveries from Shanghai refineries are stuck at the port. That inventory is now at risk, and the shortfall is growing larger. And now, with 23 million ounces of silver expected from Shanghai, that cargo is stuck. The inventory at COMEX just dropped from 41 million to 18 million ounces. Do the math. You have 12,000 contracts demanding 60 million ounces, but only 18 million ounces available. Let's dive deeper into the financial mechanisms at play. At the core of the crisis is a severe shortfall of silver in the COMEX market, with 12,000 active contracts, demanding a total of 60 million ounces. The situation is now critical. The COMEX market was already facing a deficit before the rejection from China. The available supply is far less than what is needed. But now, with China's rejection, the shortfall has intensified. As of December 30th, the registered inventory at COMEX was only 41 million ounces. That number has now dropped significantly due to the failure of expected deliveries from Shanghai refineries. The situation is spiraling out of control. The original plan was to rely on shipments from Shanghai, expected in the first week of January. But those shipments are now stuck at the port, and the inventory has dwindled to just 18 million ounces. The math doesn't add up. 60 million ounces of demand versus only 18 million ounces available. This is not just a simple market disruption. This is a structural crisis. The consequences of this shortfall are not just theoretical. In a normal market, this gap would lead to price surges as demand outstrips supply. But in this market, where paper derivatives and futures contracts rule the day, the price mechanism is skewed. The price set by paper contracts is far below the actual physical price in Shanghai. The spot price in Shanghai is now $89 per ounce, while the paper price in COMEX is hovering around $30. This massive spread is unsustainable and signals an impending collapse. As the market opens on January 2nd, traders and investors will face the harsh reality that they cannot access the physical silver they were promised. The contracts they hold will either force them to sell or settle for cash, and that cash settlement will be based on a paper price, not the actual market value. The CME Group, which owns the COMEX market, has already prepared for this scenario. On December 30th, they issued an emergency rule change, allowing for cash settlements at the prevailing paper price in the event that physical delivery cannot be met. This rule change is an acknowledgement of the impending default. It's an official, albeit under the radar way of saying, if the silver isn't available, we'll settle in cash. This move is an attempt to shield the big financial players from the consequences of a physical delivery failure. But the real victims in this scenario are the retail investors, the small traders who bought into the promise of physical silver. They will get cash settlements of just $30 per ounce, while the actual market price in Shanghai is $89. This is a $59 per ounce loss for those who trusted the paper market. What does this mean for the global financial system? It means the derivatives market is broken. The entire system is propped up by promises and algorithms, but when the physical metal is no longer available, the system crumbles. Let's now turn to the critical issue of liquidity in the system. As the crisis deepens, we can see the impact on the broader financial markets. On December 30th, 2024, the Federal Reserve injected an astonishing $34 billion into the overnight repo market. This was not a routine operation. It was a desperate attempt to stabilize the financial system. The repo market is the backbone of the financial system, where banks borrow short-term funds to meet their obligations. When the repo rate spikes, it indicates that something is wrong. In this case, the Fed's $34 billion injection signals that multiple institutions are in trouble. And when the same day sees China rejecting a bailout offer and the repo market experiencing massive liquidity injections, it's clear that the two events are connected. The trouble lies in the commodities market, particularly silver, which is at the heart of the problem. Silver is not just a commodity, it's the collateral for over $230 billion worth of derivative exposure in the U.S. banking system. This exposure is about to be realized, and the consequences are going to be catastrophic. Here's how it works. JP Morgan, among other big banks, shorted silver in the COMEX market. They sold contracts without having the physical metal to back them up. To hedge these short positions, they bought derivatives. These derivatives are based on the paper price of silver, which is being manipulated down through algorithmic trading. The real silver price, the one determined by supply and demand in Shanghai, is $89 per ounce, but the paper price in COMEX is only $30. This disconnect between paper and physical is what's driving the collapse. What happens when the contract holders demand physical delivery? The banks are forced to buy physical silver at $89 per ounce to cover their $30 positions. This creates a $59 loss per ounce. Multiply that by the 42 million ounces of shortfall, and you're looking at over $2.4 billion in losses, just from the delivery failure. But the real problem lies in the derivatives market. Every hedge fund and pension fund that bought those silver derivatives will now claim the full value of their contracts. The notional value of these contracts is a staggering $230 billion. This is the level of systemic risk we're dealing with. The collapse of the silver market is not just about the price of silver. It's about the entire financial system. We're witnessing a replay of the 2008 financial crisis, but this time it's not just about housing or subprime mortgages. It's about a commodity that underpins the entire financial system. Silver is just the tip of the iceberg. As the global economy teeters on the edge, the implications of this crisis will be felt far beyond the markets. The collapse of the silver market will send ripples through the banking sector, the commodity markets, and the global financial system as a whole. So what happens next? We are entering a period of uncertainty, and the financial landscape is changing rapidly. The days of relying on synthetic markets and paper derivatives are coming to an end. The real economy, the one based on physical assets like silver, is asserting itself. The question is, how will the world respond? What will the future of finance look like in a world where the physical economy is king? Only time will tell, but one thing is certain. We are witnessing a historic turning point.